Manager with CB3 Financial Group. I'll be joined later by Dan Tresmer from On Path Financial for the Q&A session. There's a lot going on we want to share with you tonight, but we want to be brief. We understand that it's 91 degrees out there. We understand that you probably would like to get to the club and have a nice cold beverage. So I'll start you with the line that kind of motivated me for my time frame tonight, and that would be from the great Henry VIII, King of England, as he infamously said to each of his 6 wives on their wedding day, "I hope I'm not boring tonight, but even if I am, I promise I won't keep you long." All right. So we're going to talk about the Bull's decade birthday, and then, as you know, if you've been following the newsletters and the videos, my new approach to analyzing the markets is CB3 on 3, political, fundamental, and technical influences. That encapsulates everything that I've been able to see that makes the markets move, and then we'll project what's going to happen in the second half, and then we will get you over for some nice beverages. So, the Bull's decade birthday, 10 years, and if you see in the upper corners here, you'll see 11. So 11 is the number of years that I have been holding these. Some of you have been here for almost all of those. And the reason that's 11 and the anniversary is 10 is because the first year was so terrible that that's why I started doing these Fireside Chats. So in the first half, we're celebrating the longest running bull market and the longest running economic expansion in our lifetimes, and indeed in U.S. history. For those of you who have hung with us since 2006, and I see a few faces that have been with us all the way since 2006, we thank you for hanging in there through thick and thin. So stocks kicked off a really strong 2019 with a great rally shaking off the chaotic market of the fourth quarter of last year. Fourth quarter was a pretty big correction, not quite a bear market. And the gains in the first quarter almost erased the losses from the previous quarter. And they've more than made up from that now, as the S&P is, I said on the slide, trading over 3,000 for the first time. It actually closed back under 3,000 today, but of course that would happen, right? So historical patterns, though, this is a real good positive to get us going tonight. Forecast more strength for the end of the year, and here's why. Why am I encouraged? Because the S&P 500 percentage gain in 2019, in the first quarter of 2019, was rare. Okay? When stocks start that strong in the year, and it usually bodes well for the rest of the year. Why? Because there's going to be probably an additional 6 to 10% if market history plays out. So only 10 times since 1950 have we had this strong a start in the first quarter. So because of that, I think we've got a pretty good shot at finishing strong. As has been the case for the last 5 of the 10-year decade celebration here, the NASDAQ has led. You can see the NASDAQ is in first place, followed by the S&P, followed by the Dow. They have juxtaposed over the quarters, but for the most part, the NASDAQ is your leader here. And of course, the Federal Reserve is playing a big role in this because they're hinting now at actually easing instead of tightening. If they were to ease on July 31st of this month, it would be the first easing, in other words, a drop of the Fed funds interest rate in over 10 years. The other component that made this first half so successful is GDP. The red line shows you the ideal 3% GDP that we want to see in this country. We actually clocked in at 3.2% for the first quarter. Now, I think when the second quarter comes out, it's not going to be 3.2 or even 3. It's probably going to have a 2 handle on it, maybe in the middle somewhere around 2.5. That's not bad because it's still on the plus side, but just realize that we continue to have this rather lackluster but still positive growth all this time. It has not been a smooth ride, however. If you look at the chart here, you'll see the purple line, which shows, you guys I'm sure saw your accounts from September through June. It took that long to get back to where we were with the market highs of last September. The whole fourth quarter would be one to forget. We've had some of those over this 10-year period. But that's just the way it is. The S&P experienced a 19.8% correction, which is 0.2% away from a bear market. But it didn't hit it, okay? So what else has made this first half such a success? That's going to be employment. Hiring has continued at an above average rate for the expansion, averaging about 200,000 jobs per month, which is strong. You'd like to see 300,000, but we've liked to see a lot of things that we haven't seen in this 10-year recovery, like we saw after the recovery of 2000 or back in 1987. We're just happy with 200,000, okay? Overall, the U.S. economic picture has supported this continued expansion. Modest inflationary pressures helped boost demand and support corporate profit margins in the first quarter. All those facts together are why we are where we are. As far as employment goes, almost every sector of the economy, if you can see on the screen, construction, transportation, business, education. It was nice of the sun to go down so we can actually see the screen. But two areas have not kept up with employment, okay? Anybody want to offer, you guys that have been here long enough know that I have audience participation. Why are information and the retail sectors not keeping up with the employment that the other sectors are? There's two reasons. Anybody? Very good, Leo. The answer is Amazon, in one word, and automation. So Amazon is affecting retail, and automation is affecting technology. Now, for us as investors, technology is a great place to be. But if you're working in the technology sector, why? Automation is limiting the upside as far as jobs there. And yet, productivity is as good as it's ever been. In fact, if you look here, you can see on a steady increase from the end of 2016, almost a straight line up through 19. You can attribute that to the current administration's policies or just clairvoyance, but that's the reality of what's on the chart. All these things play into the success. Consumer confidence, the dark blue line you'll see is way up at the top. You guys have been hearing from me for 11 years that we've been doing these. There are three and only three components that make America grow. There's government spending, there's business spending, and there's consumer spending. I'm sure you all know by now, if you've been listening to my speeches, that consumer spending is 70% of that. So when the consumer is confident, they are spending and businesses are making more widgets, and that's what we want to see. What this tells me is that even with that downturn of the last quarter, consumers did not lose their confidence and they continue to spend. And here's another interesting fact that I didn't see until just a few weeks ago. I'm glad to be able to include this. For years, many of us as economists thought that falling wages, high unemployment, was proof that low-wage workers had to get retrained. They just had to. But what we're seeing now is that's not the case. What they really needed was time. They simply needed time to wait it out. And on this chart, the blue line are people with less than a high school diploma. So even though they languished from 2009 through 2014, look at the spike that has happened since then. So when you hear the people in the media say that this is only affecting the rich, the tax cut was for the rich, the job cuts are for the rich, the data disproves that. So college graduates and those with a high school diploma, as you can see, have pretty much been flatlined. It doesn't mean they're losing jobs, they're just not gaining at the same rate as lesser skilled people are. To me, that means this recovery is widespread and affecting all areas of employment. One of the reasons that I do these speeches is so I can clarify the misinformation that they tell you in the media, because they have an agenda. They want you to watch, they want to make you hysterical, who knows, they want to sell you something. I'm telling you, this is what the hard data is. So there it is. This is the 10-year recovery. This is the happy birthday that we celebrate tonight for not only the longest bull market in history, but the longest economic recovery in history. It's a major, major thing. It occurred to me, though, that if I'm going to highlight this birthday, I probably should point out a few significant deaths that have happened already in 2019. The first would be Gloria Vanderbilt. So the Vanderbilt estate, worth billions and billions of dollars, and now she's gone. A passing of an era. She died of cancer. This next one is interesting because this fellow actually shot this creature. This creature died by a shotgun blast. I don't know if you know what this creature is, but it's kind of rare. But they can be nuisances in summer parties, and that's what happened. This creature came up to this guy's party, he shot it, and he made the headline with this. Anybody know what this skull is? Well, I'll tell you, it's actually a northern Illinois mosquito. So when you've been wondering why your fly swatter's not working, that's why. Number 3, Ross Perot. I can still hear Ross saying, "You hear that sucking sound? That's all those jobs going to Mexico." You guys remember that in the debate with Bill Clinton? Well, long live Ross. He did his best. That's a summary of what's happened in 2019 so far. So let's look at the components, political, fundamental, and technical, that are going to influence what happens in the second half of this year. I have this montage of various political influences, and every time I present one of these talks or in my newsletters, I just focus in on one or two of them. Tonight it's going to be tariffs, more so than taxes. Okay? All right, you've seen this slide before, and that's because it's still relevant. Taxes, tariffs, Trump, and trade. And this is because, more so than any president in my lifetime, maybe in the last century, a tweet can come from this man and change the whole political landscape and can change what happens in the markets. So this is Trump and Xi Jinping shaking hands at the recent G20 meeting. What you've been following, I'm sure, in the news media, is that President Trump has been orchestrating these huge tariffs, huge meaning 3 digits, 100 billion, 200 billion, 300 billion, and threatening tariffs on the remaining however many billion that there's a trade deficit with China, okay? And this picture's in here for a reason. China then retaliated with levies of 25% on 60 billion. So what's the big difference here? Trump is leveling with 3-digit numbers, and Xi Jinping is doing it with 2-digit numbers, and that's because there's such a massive trade imbalance. So he just doesn't have the ammo. Now, over the years, you guys have counted on me to bring you information that sometimes the regular media doesn't have. So one of my sources on the inside actually had an audio feed for their final shake, their final handshake at the G20, and I was able to get the audio clip, and this is what they said. I didn't put the audio in here, I just put the image on the screen. Sad to say, but that's the state of things with our guys. This is the reason that they're squabbling. Ever since 2010, and that's way before Donald Trump, the GDP of China has been dropping. They were used to seeing this incredible growth for decades, and it's been doing nothing but dropping over the last 10 years. And that is because they are an export-dependent nation. 17% of the US economy is dependent on exports. That means 83% we are consuming domestically. China is more like 60 to 62%, and you have to just weigh those numbers with a grain of salt because I don't really trust data that comes out of China. But the reality is they've been on a steady decline, and these tariffs only make things worse. So the media will tell you that markets are crazy to ignore these risks. This is the last hurrah. This clip was actually from 6 months ago. I put it in here to show you just how wrong this media person was. With the economy as tight as it is, any restriction on trade will be perilous to the US economy. It's just not true. China is languishing in a bear market amid worrisome trade news because it's a big deal when 60+% of your economy is in jeopardy because of tariffs. Now here in the West, our leaders from Mexico, the US and Canada are here signing, and they're one step closer to replacing NAFTA. I think USMCA is United States, Mexico, Canada agreement is one step closer to replacing NAFTA, North American Free Trade Agreement. So we're hoping that's going to happen, but it's going to need, obviously, votes in Congress to get that. So, do political entities, do business entities have concerns about this acrimony with trade? And the answer is yes. You can see it on the chart. Do these trade tensions cause business anxiety? They do. But does the market care? And my response is the S&P above 3,000 indicates that the market does not care. On any given tweet, they might. It's great for day traders, but in the long range, people are buying those dips. Market dips down, people come in and buy it because the market doesn't care the way that the media wants them to care. Earlier, I mentioned this trade deficit with China and why they are so dependent on exports and we are not. The red bars that you see are a deficit that we have with China. If you flip it, that means they have a surplus with us of those huge bars. So the little bitty blue bars, you'll have to strain. Those are the areas where we have a surplus with China. Now, who do you think has more clout to try to level this playing field? The US. And this is only getting more so as time goes on, because every month that a deal is not done, China is paying these tariffs, and the pressure is on the president of China to do this. Of course, he's elected for life, so Those are the political influences. Let's look at the fundamental. Political drives the fundamental, but the fundamental is different, okay? We look at these areas, and again, just like in the first section, I like to hone in on just a few of them, and really the scene right now, what's really salient is jobs and inflation. So in June, we added 224,000 jobs. We'd like to see that at 300, but we've been liking to see that for a decade. What we are seeing is steady plus over 150, sometimes up to 300, but 224 is a good number. This is what it's looked like all the way back to 2007. The last 12 years of job growth is not runaway great. Sounds like it's bad, but it has been positive. If you zoom in and look at the last 8 years, it's positive, but not exactly on fire. Why is that good? Because it means we don't have inflation. As Jay Powell said, the chairman of the Federal Reserve, we don't have any evidence for calling this a hot labor market. To call something hot, you need to see some heat. And he's not seeing it, which is why he's concerned, even though the markets are doing great, even though inflation is low, even though unemployment is low, there's a chance we're going to see a 50 basis point cut on July 31st. I think it's going to be 25, but the futures say there's about a 26 to 27% chance. Why is this so tight? How can we continue to have unemployment drop month after month after month? It's right here on the screen. The unemployment rate hit a low, a lifetime low of 3.6%. I shouldn't say lifetime, in our lifetime, so back to 1952. The underemployment rate also hit a low in the 2 handle. You can pile on more versions of this. You can look at part-time plus economic reasons or marginally attached, which sort of sounds like workers that are scotch-taped instead of stapled. I don't know where they get that. Plus discouraged workers, headline unemployment. You can put any number in there you want to measure the unemployment rate, but they're all going straight down. And that is good. That's just great for the economy. Each one of these measures shows that unemployment and underemployment continue to shrink this whole decade. Okay? All right, wage growth. So, if there are very few people that are not able to find a job, you would think that workers could demand anything that they wanted in the way of wage hikes, right? And if they didn't get it, they would just pick up and leave and go somewhere else. But that has not happened. It's very odd. I've never seen this. If you go back 100 years, I've never seen this. What you're seeing on this flat line from 2010 to the current date is the inflation rate with weekly wages. They're pretty much tied together, which means if you want to get a boost in salary, you've got to train yourself for something different. Because employers, still looking back 10 years and how much they were burned in the crash of 2008 and 9 are saying, we're going to pay you this wage and this is pretty much going to be. We don't see inflation. We don't see a reason to give you more than the 2.5% raise. There's plenty more people out there that are interviewing for jobs. And it's because of this that this recovery has been so unusual. It has been stable as for us as investors. If you're working out there, it's not necessarily great. Various sectors of the economy where job growth has been, you'll see all of them have large blue bars or medium size except the last one. Same one we pointed out earlier, Leo. Retail. And that is solely because in this last decade, it is clear to all of us that online retail is the future. It may not totally supplant brick and mortar, but it certainly is headed that way. Okay? All right, so trade imbalance. These are the 2 issues I wanted to talk about in fundamental. So I want to point out to you that the absolute worst trade imbalance we ever had was under George Bush. Okay, it actually got much better under Barack Obama, and now it's headed back down under President Trump, which is to say that this is such a big area of the economy that it really transcends any one administration either having to take the blame or taking credit. Red on the screen means that other countries are exporting more to us than they are importing from us. And it's this imbalance that has gotten the current administration really, really upset and saying, we're going to do something about it. And it is painful to get to the point where I hope when I'm doing this in 5 years that this red chart is gone, that we have an equilibrium of world trade. It would be wonderful. But for now, we don't. So what does Jerome Powell see? If things are so good, usually the Fed is cutting interest rates when things are bad. What is he seeing? Well, what he's seeing, I think, is that global issues are far greater than the issues right here in America. And because his peers at the Bank of England, at the Bank of Japan, obviously the Eurozone, his peers, I think, are saying to him in private meetings, look, we got problems. We have bonds with negative yield, which we'll talk about later on tonight. We need you guys to cut. And he's going to do what he has to do. I think he's also getting President Trump pressure. But he's seeing data that is leading him to believe that I don't want to wait. The Fed has been notorious for knee-jerk reacting rather than being preemptive. He said that the June job report, which showed stronger than expected hiring, which I just showed you, the 224,000, was great news, but not enough to tilt the balance because wages aren't rising fast enough. I just showed you that screen. So because of that, he's saying, I want to put a little juice in the economy, and we're going to probably do 25. Of course, he can't telegraph that. But again, the futures market is saying there's about a 0.25% chance or 26% chance it's going to be 50 basis points. And I don't think it's one and done. I think that we are now done with the increasing interest rates, and we're going to have a loosening policy, which would be great for the markets. So again, Powell's made it clear that inflation is too low. Something else from his recent speech, the economy is performing well. We all know that. But when the Fed acknowledges it, that's obviously a positive. So guys, I'm sorry about this clicker. Here we go. Inflation has been running below their 2% target. So the Fed has a dual mandate. The Fed's job, their sole job, is to keep inflation right around 2% and to keep unemployment at full employment. Well, that doesn't mean zero. You're not going to see an unemployment report with, oh, it's zero. 3.6 is amazing. If it ever got to 3, that's going to have to be considered fully employed. And that's their dual mandate. All right. So last shot here, and this is looking at GDP since the recovery going around the globe. Okay, at the very top, you'll see the US. Underneath that, you see Canada. Underneath that, you see Mexico. We're clearly the winner, although we've been neck and neck with Canada. Canada is an economy that is 1/10 the size of the US. Germany is about 1/3 the size of the US. So that we have been able to be this strong for 10 years explains why some of you that have been with me for a long time, when you used to see emerging market assets in your programs, and you don't see that many in the last 10 years, this is where things are happening, this country. I think the rest of the world is following us. I think that explains why we're lowering rates because of international pressure at the peer level of Jay Powell. Technical influences. This is the third of the three. Sometimes this is the least favorite, so guys, hang with me. Let's review a few definitions. What is a pullback? A pullback is when the market makes a high. We're going to call it $100. A stock is, and by the way, a pullback, all these phrases work for stocks, bonds, currencies, anything. It doesn't have to just be the overall stock market. But if a market, if a stock or if an index trades to 100 and it pulls back to 90.1, that's going to be considered a pullback, okay? A correction is more than that, between 10 and 20%, okay? These aren't exact numbers, but that's roughly what we consider it. So a bear market then is when it's greater than 20. So that $100 level that I gave you, if the market then trades, let's say a stock goes IPO at 30 and just zooms up to 100. If it trades back down to 80, that's a bear market. Let's say it goes down to 50, and then the buyers come in and it trades to 60, then that's the beginning of a bull market. Why? Because 60 is 20% higher than 50. Make sense? It's important. I want you guys to understand this. Okay, so technically, with that in mind, let's look at where we are now. A recession. There's actually no standard definition for recession, although I have mine. The government, National Bureau of Economic Research, calls it a significant decline in economic activity. What does that tell you? Nothing. Okay? It's visible in GDP, real income, employment, industrial production, and wholesale retail sales. In any of those areas that I've talked about earlier tonight, do you see weakness in any of those areas? No. Okay, so what are the chances that we are imminently facing recession? Almost zero. A recession begins after the economy reaches its peak level. We're using that 100 that I just mentioned. And when it hits its trough, that's the end of the recession, and then the expansion begins after that. The way that I define a recession is 2 consecutive quarters of negative GDP growth. We've only had one in 10 years. We only had one. Of course, everybody went, hope the next one's not. All right, but it didn't. It didn't happen. So we'll talk a little bit more about recessions at the very end here. So these are my famous relative rotation graphs. As a quick reminder, the upper right-hand corner on my screen and yours too is green. That's where we want to be. We want stocks or indices or markets in that quadrant. Underneath that is weakening, which means if it's trading there, it's still beating the index, but it's weakening. Red is definitely not where we want to be. That's lagging, and blue is improving. It can be good to be there as long as they continue to proceed into leading. So what you're seeing is a lot of confusion in the middle of the graph because none of these markets is doing particularly anything. The U.S. is buried in there, and I'm actually going to show you on the next slide. If you can't see the U.S. in there, you will see it on the next slide. And I'm doing something a little different on this slide. Do you see the lines moving? This is actually how I analyze. So what you're looking at is a repeat of the last 2 months. So every jump of the line is 1 week. And so I will literally sit and mesmerize, if you will, on the patterns and what's happening here. So over the last 2 months, what I can see is that the NASDAQ is in the lead. And the NASDAQ started in weakening and catapulted into leading. And the S&P saw that and followed it, just like a little puppy following its mom. And the Dow did the same thing. So this tells me that in case I was wondering, the NASDAQ is absolutely the leader, which is fine because technology is what differentiates us from other markets. Not that other countries don't have technology, but ours is supreme. The concerning area on this chart is to the left with the Russell 2000, the small cap space, which is where companies incubate. Microsoft, Abbott Labs, AbbVie, all these companies did not start as $300 billion entities. They started as small caps. And the small caps are not recovering yet. So one of two things, and only two things, is going to happen. Either the small caps are going to drag down those on the right side, or those on the right side are going to pull the Russell up. And that's what I'm banking on. That's what we're watching mostly, technically, in the second half. Okay, and most of our programs have some small cap. We actually have a program that's all small cap, but most of our programs have some small cap in there. This is the same graph, but now we're just focusing on the S&P. So forget Shanghai and all those international markets. Forget the NASDAQ and the Dow. This is just the S&P 500. And I want to point out to you, there are 11 sectors, and which ones are doing well. If you can see the highlight there, technology, which I've been talking about a lot tonight, industrials, consumer discretionary, oddly enough, consumer staples, which is odd to have that up there in the leading sector. But what is important about this is that the risk-on part of the market, these sectors are leading. Now in November, what you saw up in here were the utilities and the staples and real estate and healthcare because people were pulling money out and getting more conservative. But since January, this has been the story, and this is where money has been needed to be. This is the research that we do. And I don't just look at static charts. Now that you've seen the little arrows move, I sit and watch these and how they're rotating so that we can make the best decisions for you. Okay, second half forecast. I told you I'd be brief, like Henry VIII. All right, looking to the second half of 19, how do you prepare? So the forecast, this is from actually LPL and Bloomberg, for 2018, we're about a 2.9%. For 2019, they're estimating overall 2.25 to 2.5. I think that's low. I think we're going to clock in about 2.75. I do not think it's going to be 3 for the year. I wish it were, but I just don't see it happening. The developed U.S. is actually growing. The emerging markets are predicted lower. Global predicted lower, not by much, but they are. Inflation, not moving. I showed you the graph earlier. So these are pretty sizable entities. Unemployment dropping back to 3.6. I think we'll see a 3.5 or a 3.4 print, even though more people are coming into the marketplace. Why? Because underskilled workers, remember that graph that I showed you, are finding jobs. Who thought that they were ever going to find jobs? I didn't until I saw the data just weeks ago. All sectors or all socioeconomic groups of America are benefiting from what's happening now, according to the data, all right? Given these solid fundamentals, we continue to believe that corporate profits will exceed the current expectations. So, is that really the case? Well, you guys have seen this before. This is from Reuters, and what they do is they chart the number of surprises. So, when the quarter starts, we start getting the reports, earnings reports from the previous quarter. And they always start kind of in the 70s. Well, this actually started in the 80s. I've highlighted it. I don't know if you can read the number. We've got an 83% beat, which means above what was predicted. That's great. Now, as the rest of the S&P 500 reports, it usually gets dragged down. It rarely goes up. But the encouraging thing here is this number's not dropping to the 50s or the 60s. This is above what we've seen. This is 18 consecutive quarters of positive earnings growth. Granted, the financials have not done real well this week. And Netflix, just hours before I got here, had a real shocking subscriber drop. And the stock was like down 10.5% in the aftermarket. But we've been there, right? So the growth meter is on slow. Just get used to it. It's okay. It's okay. Even if we continue to see slow growth, the U.S. job market continues to be the bright spot. I think I've shown you that tonight. Hiring continues to be at an above average pace, although it's not stellar. But Jay Powell is going to come in, cut interest rates. And again, I don't think it's one and done. I think it's going to probably see the target back at 175. That's where I'm thinking. Weekly claims have dropped to cycle lows. A cycle is this 10-year period. Okay, this 10-year secular bull market. Several times during that, we've had weekly unemployment claims, people that need a check because they can't find a job. They've dropped to lows because, again, if you're breathing in this economy, you can pretty much find a job. I put this snail in here because I just thought it was a cool graphic. Strong growth leads to higher incomes slowly. We saw that incomes aren't really rising that much, but just remember the snail. It's good because when you have something moving this slowly, it's going to take something really, really big and omnipotent to bring us down into a recession, in my opinion. Here's the inflation graph, a little different spin on it. So the separation between core inflation and all items. So you guys maybe have heard there's two ways they measure CPI, including energy and food. Now, energy, as you know, with crude oil, those prices vacillate all over the place, as do food. Okay? But that core number at 2.1 is really, really low. The all items, if you take those numbers out, is 1.7%. It's astounding. It really is astounding that inflation has been this low with the unemployment market as strong as it is. Okay. I don't say it used to be every month. Now it's probably every quarter. I get a question from a client that says, what about the dollar? I'm just really concerned that the strength of the dollar is just going to blow up and there's going to be another world reserve currency and the Arab countries are going to start trading in their local currencies and the dollar is going to be excluded. Once again, you're watching TV too much, and I'm not accusing you of that. Here's the data, okay? Bank of International Settlements. This is where all the huge clearinghouse is for transactions. That bar at the top you see is 88% of all transactions in the world at the commercial level are made with the US dollar. If you add up the euro, the yen, and the pound together, they don't equal what the dollar is. There is not a person in here alive, including the really young ones, that will see the dollar not be the world's reserve currency in their lifetime. I just don't see it. I think that is one more underpinning for the strength of this economy. All right? We'll remain it. Nothing else even comes close. This is encouraging to me, that industrial production, retail sales, investment, these are three areas of the economy that we track together, because if they're tracking together, that pretty much means 85% of the people out there are in one of these areas. And what I like here is this spike at the end. So it means that that downturn that happened in December, which none of us like to see in our accounts, but the consumer, the retail industry, the fixed investment, industrial output spiked right back up in January, which means they were not discouraged. They, as this huge 200 million population, by what was happening. It's almost like we've become resilient to these pullbacks. The low of the market in 2009, we had downturn in 10, we had one in 12, 14, 16, and of course, the fourth quarter of last year. But it bounces back. It bounces back, and that's encouraging. Earlier, I mentioned that with a 10-year recovery, you have to be thinking, we've got to be due for a recession, right? So you probably know this, but if you go and flip a coin at a blackjack table or wherever you are in Las Vegas, and you do it 50 times, and 46 times it comes up heads, what are the chances that it's going to be heads on the next flip? 50%, okay? There is nothing that says we have to enter a recession. And the reason I have Australia on here is because they have not had a recession in almost 30 years. This recovery is 121 months long. As of last month, happy birthday to the market and to the economic recovery. Is there room for more? Absolutely. Australia has not had a recession in almost 30 years, but there's one country that has been more than 30 years. This country. They have avoided recession for 30 years. And I'm almost hoping you can't see it on the next graph, and I have to wait for the type on. Yeah, you probably can't. The red line is that country, gave it away. Vietnam, look at the downturn in 2008 for the US. Look at the downturn in 2000. Now, comparing Vietnam's economy to the US is like comparing a hot dog vendor on the street to Portillo's. I get that. But the reality is it's a confluence of factors that causes a recession. Like him or not, I believe Jay Powell has a colossal ego, and he is not going to have a recession start on his watch. I think he's stronger than Janet Yellen. I think he's stronger than Ben Bernanke. He's the strongest Fed chairman we've had since Greenspan. Add that to a president who also has a colossal ego. I don't think these confluence of factors with these people able to influence monetary policy and hiring, I just don't see it. I don't see a recession anytime soon, and we do not have to have one just because we've had every 8 to 5, 7 years, okay? I think there's more upside. Again, continuing to review factors of why I think the second half is going to be good. The Job Cuts and Tax Cuts and Jobs Act still has more to go. So here's one area. You probably remember that in this tax cut, and this is when the Republicans controlled the whole governing branch, they passed the business tax cuts at a permanent level, but the personal tax cuts were only for 8 years. If Trump is reelected and the House swings back to Republicans, that will be put in on a permanent basis. There'll be enough votes to do that. If those tax cuts are put in on a permanent basis, that means it takes 2/3 of Congress to nullify that law going forward. Again, irrespective of your social viewpoint of this, as far as jobs go, that's a positive. And that's why this act can be important. So I like this logo, FANG. You guys probably know this acronym. Facebook, Apple, Amazon, Netflix, and Google. Now, we all know that Google is really called Alphabet, but nobody in our business calls them that. They're still Google. Now, Netflix, literally just hours ago, I always feel like I got to come with the most information, shocked by having half the subscribers, new subscribers domestically than they thought they were going to, and they dropped 12.5%. And some people went in and bought them on a day trade, and then it closed down in the overnight market, only down 9%. So I was kind of happy about that. But the point is, $3.7 trillion is what these companies were worth. There we go. $3.4 trillion. Technology is king. Now, Amazon went into a bear market last year. In the fourth quarter, the rest of the stocks were fine, but Amazon dropped 24% from its peak. So one stock can't bring down the market. But if these 5 companies are doing well, $3.4 trillion is a higher net worth than many of the US states. And it's also higher than many of the European and Asian countries. So we watch technology like a hawk. It's really, really important. I keep this graphic in here because, again, this looks like a Saturday Night Live parody, but it's not. This is really from the cover of Fortune magazine. Is it tongue-in-cheek? Probably. But this isn't the kind of stuff you want to watch. To be fair, though, I have Gary Schilling in here, who predicted the last market downturn. He says that a recession may have already begun. So I'm trying to be fair and balanced. Sorry to quote Fox News there. Why does he say this? Well, he is saying, you've undoubtedly noticed that the bond market's been kind of strong. So the recession may be underway, he says, because the bond market rally. You might remember that the rates, last time I was here, we were talking about 10-year rates at 3.25. And if it had broken out above that, 3.5, 4, then all of a sudden fixed income looks pretty attractive. It gets to 5 and 6. That's really not good for the stock market. That didn't happen. What happened is it bounced off of that twice, and now actually the 10-year yield traded down below 2%. He's saying that he thinks it's going to go to 1%, and that if you're investing in bonds, you might see as much as a 2% a year gain, a drop, the yield drops to 1%, and you could be seeing double-digit returns in bonds. If that happens, if I could offer you today 10 to 11% in a bond, you'd probably pull a whole lot of money out of stocks if the government's backing that investment, right, and put it in there. But I can't offer you that, and I haven't been able to offer you that since Reagan was president. Reagan, okay? So if he is correct, 10% gain, 14% in the 30-year, he could be right. But none other of the data that I've shown you aligns with that. But I put this in here to try to be fair and balanced. This is a scenario that could be really adversarial to the stock market, were it to happen. We are watching it. One more topic, and then we're going to be off to the races here. I mentioned earlier that even though our rates are low for bonds, in Europe, there are trillions of dollars of bonds that are at a negative yield. I've talked about this before, but I want to elaborate on why this is so important. So if you loan a bank or any entity $1,000 and you're getting 3% interest, right, you expect to get back $1,030. Okay, but there are banks and plenty of corporate entities that are loaning negative amounts, and you're loaning $1,000 and you're getting back $993. And you might say that's crazy, and it is crazy. Why would you invest in a bond that will lose you money? Negative rates are at odds with the basic financial principle that if you loan money, you should see a return. But this law has been broken in the last 5 years, not in this country, but in Europe especially. Why is that? Okay, who benefits from negative rates? What a shock. Governments benefit. They can loan billions of dollars and get back less than they loaned, okay, more than they loaned, pardon me, because they're actually taking from the principal of the people that were the deadees, and they have a great incentive to loan that money. It's not a healthy situation. Why would anybody do it? Well, it's a pretty simple answer. Because there are some investors who think a negative return is better than the risks in the stock market. As carefully as I could do tonight, I have tried to show you why, yes, there are risks in the stock market, but there is not any more risk today than there was 5 years ago. Certainly less risk than there was in 2009. But there are entities that are content to work with negative yields. So what are they doing? They're picking up their money and they're coming to the U.S. Okay, this bodes well for us. Of the top 10 economies in the world, the U.S., I update this graph every time I see you, the U.S. is still far and away number one. If you add China, Japan, and Germany together, they're only slightly larger than the U.S. economy. That's why we invest here. And finally, on stock valuations, the S&P's forward 12-month PE, relative to historical norms, is still fair. Why is it fair? And it's because you can't just look at a pure PE ratio. You have to look at what is the interest rate environment, which is low. Okay, what's inflation, which is low. So that means we can afford to pay up a little bit more for these stocks. And therefore, I think that 17.5, you probably hear that 18, 19 are fair PE ratios to be paying for growth stocks. 17.5 is fair. And based on this, and now I'm predicting for the end of the half, the S&P will be about 3,100 to 3,200, or 3.5% to 9% higher than it is right now. Obviously, there's an asterisk on that, because with the right tweet, or in this case, the wrong tweet, all of this can change. And I can't predict that. I just can't. But based on what we're seeing, that's where I expect the S&P to close. So this is my summary. I think the S&P is going to continue to rebound from the December 24th low. Who would have thought, lump of coal, that December 24th was going to be the low? Why? Strong earnings, economic growth, full employment, low interest rates. Everything I've told you tonight supports this hypothesis. Interest rates are going to be falling. It's not going to be one and done. In my opinion, you're going to see the drop from where it is probably down to 175, maybe 150, and then the Fed will pause and see what they can do. I do not see any risks challenging to the U.S. at this time. I do not see anything likely to derail the market in the second half, based on the data that I've given you. And Jay Powell agrees. The bottom line is that the economy is in a very good place, and we want to use our tools to keep it there. To me, that's a very proactive statement. Janet Yellen and Ben Bernanke would never have made a statement like that. He's basically saying, this thing's not failing on my watch. And whether you like the guy or not doesn't matter. He wants to see this growth continue. And so do we. Right? I want to remind you, with the predictions that I've shown you tonight, I show this every time, that a portfolio manager's ability to react is imperatively more important than our ability to predict. So I can predict all I want, but my ability to react to that and put you guys in a better place, either in a more opportune place or in a less risky place, is far more important than my ability to predict. If I could predict everything in advance, I used to joke, you've heard this probably 10 times, Warren Buffett, I could go work for him. But the truth is, if I really could predict well, he would work for me. And since we can't, we have to develop our ability to react. And so my recommendation, stick with us, guys. On Path and CB3, you've been with us for the last many years. Read our newsletters, watch our videos, attend the chats, go to your reviews, and keep calm. And remember, as I tell you every time, at CB3 Financial Group, we don't just manage your assets, we become one of them.